It's that time of the year when your organization will start asking you about which tax regime you're going to choose. Yes, from here on, by default, you will fall under the new tax regime if you don't opt for the old tax regime. So the question is whether you should opt for the old tax regime or the new tax regime, right? So let's have a brief discussion and with live examples where I'll show you what makes more sense for you and whether you should give up on all the investments that you're currently doing for tax saving if you're going to take the new tax regime, or should you retain some of them, which are the ones that are redundant and you needn't go for if you take the new tax regime, and the ones, of course, you can continue if you decide to be in the old tax regime. So let me walk you through that very quickly. You should understand what you will not get in the new tax regime if you opt for it. What you will not get in the new tax regime are all the kind of concessions and deductions that you may be presently enjoying. Things like your HRA, things like your ETC deductions, which is a chunk of your deductions, your life insurance premium or Mediclaim premium, or your tax saving funds or your tax saving deposits, your PPF, your NSC, all of these fall under these kind of deductions. So these deductions will not be available under the new tax regime. So if it's not available under the new tax regime, how is it even beneficial for you? It's beneficial for you for the simple reason that it does not even tax you up to a certain point because of the high standard deductions and other rebates that it enjoys. So for a total taxable income of up to 7 lakhs, when I say total taxable income, your salary income plus your other sources of income, less whatever. In case under new tax regime, there isn't really any deduction. There's only standard deduction. But all these put together, if it is less than 7 lakh, you actually don't have tax. That's what makes the new tax regime very interesting and helpful for young investors, freshers who have just taken up jobs, etc. Right? So your pay package is rarely going to be very high. So if you start off with this kind of an income, then it makes a lot of sense to just close your eyes and start with the new tax regime as far as taxability is concerned, right? And also look at the kind of slab we have here. The slab is more gentle, right? So 3 to 6, 6 to 9, 9 to 12. Let me give you an example. For example, if you are earning, say, even 12 lakhs per annum, under the new tax regime, your tax bracket becomes 30%. But here, you could actually restrict it to even 15%, right? So this is where the new tax regime is being made attractive. No frills, no deductions, but I'm going to tax you lesser. So if it suits you, take it. That's what the government is trying to tell, and it is trying to actually push people to the new tax regime because it's simplified that way, right? So this is where we are now. This decision about whether you should go for the new tax regime or old tax regime will depend on whether you are already taking a lot of deductions. If you're, say, in your well into your 30s or 40s, you have a home loan, you have your policy, medical policy, life insurance policy, and you're claiming deductions. Sometimes this might be useful, the old tax regime might be useful for you if you're in the higher income level. I'm just going to take an Excel sheet and give you some examples for you to understand this, right? Let me just give some inputs here. Please remember, this article that I'm showing you and this particular Excel is an attachment in that article. You will find that below this video. You can go, it is a free article. You can go download this Excel and use it. You can also read the article fully. And please remember to subscribe to our channel and like this, so that you will get more such useful inputs in future. Now coming back, let's take this, right? I have somebody here with a pay of 5,90,000. They have allowances. I have made provision for HRA, and this is the total salary income. And there is some, I haven't put any income from other sources. I can actually put, supposing you're getting even your interest from your savings account, which is beyond 10,000, or you're having interest on deposits. Say this is the amount. Let's see what happens here. I have not put any ATC deductions, but I have home loan interest and I'm paying some house rent. Oh, you will see the calculations here, the detailed calculations, is all available for you to see in the other sheet. But the output here says old tax regime, you will pay slightly higher than the new tax regime, right? So this is because, I am claiming some home loan, etc. Let's suppose my income is slightly higher. Let's suppose my basic is say 7 lakhs. Here you will see that old tax regime you're starting to be taxed more steeply because 7 lakh plus 1 lakh 20,000 you're already falling into a new slab, whereas you're not being taxed that much here. So in many cases where you have less deductions, but in this case, let us suppose I'm going to save up to 1 lakh in etc, right? Here you will see that the new tax regime will charge you far lesser than I'm sorry, the old tax regime will charge you far lesser than the new tax regime. Why is it so? Because there are deductions. If there are no deductions, supposing my home loan is zero, and look at, I have just made my home loan interest zero. I've just removed ATC. Look at the difference in the taxes: 75,400 in the old tax regime, 41,600 in the new tax regime, right? So this is where things stand. So here again, this is above 7 lakhs. Let's assume that your basic here without the other components is 5 lakhs here, and you don't have any deductions here. I don't even pay tax, whereas I pay 33,800. Let's suppose out of 5 lakhs you're able to save 50,000 in etc, you're still paying 23,400 in the old regime and nil under the new regime. Please remember, any other form of short-term even capital gains will be added to income from other sources. So you can bunch them, and long-term capital gain in equity, etc., is anyway taxed at a separate rate. So don't try to bunch them under this. So this is the calculation. You should use it and figure whether. I mean, figuring is very easy if you don't really, do any tax saving at present and your income is less than 7 lakh. Figuring is easy if you're doing tax savings and your income is less than 7 lakh. You can still go for the new tax regime. But if your taxable income is more than 7 lakhs, then using this calculator will be mighty useful for you. Now let's go back to the article that I was talking about here. So one of the reasons why the new tax, like I said, is looking prettier is because of the more smoother tax slabs. So you are very slowly taken to the new higher rate. Whereas in the old tax regime, you quickly move to a higher rate the moment you touch, 5 lakhs and 10 lakhs and so on. Here you can see there is 3 to 6, there is 6 to 9 and so on. Now, having said this, the biggest question now is, yes, I am having some deductions, but it seems like the new tax regime is better for me. So should I give up on the various investments or premiums that I'm paying because I don't need it anymore? I don't need it because I'm under the new tax regime. It's favoring me much better. Now, let me kind of try and classify those things that you are already investing in or saving in that you should continue to do even if you're in the new tax regime. Health insurance policy, irrespective of whether you're in the old tax regime or the new tax regime. Under the new tax regime you won't get deduction, but it is a must have, so please don't even think of stopping your health insurance premium. Similarly, your life insurance, your pure term cover, same applies. Nothing changes. It's a risk cover that you have taken. You should continue to have it, right? And similarly, if you're a senior citizen, you're having a senior citizen scheme, you're getting ATC benefit, but under the new tax regime, you won't. Don't stop it because the interest that you get in senior citizen scheme is very, very attractive for you to continue to stay there, right? So these are things that you don't stop: your life insurance premium, your health insurance premium, or having a senior citizen scheme. Things where you can cut out, but it is still good to have them, are your PPF, even your NPS. Although NPS may not get deduction under the new tax regime, NPS still gives a very good, makes for a very good investment option, simply because, especially in the debt, the corporate and the government guilt, because their taxability is a lot more favorable today than debt mutual funds, right? About 60% of your corpus you can take out even without being taxed, right? So that makes for a great option. So it makes sense to to continue NPS, it makes sense. For PPF is not a must have, but if you're looking for extremely low risk options, yes, PPS. And then immediate annuity plans, sometimes you are going to retire suddenly at 50, 55, you start to generate income, you don't know where to go, then immediate annuity plans. I'm not talking of the deferred ones where you start paying now to get 15 years, 20 years later. Those you can cut out. I'll talk about it. NSE is not a must have. You're not going to get deduction, but you do get decent rates and they are very safe. So to that extent, you can continue. Similarly, corporate NPS. If your company is having an NPS, obviously, that makes sense for you to continue. So that's where we are. And please remember, the employer contribution to corporate NPS is tax deductible under the both old and the new tax regime. Now, what you can skip? Things like tax saving funds. You can invest in regular mutual funds. You don't have to do tax saving funds if you're in the new tax regime. There is no real return benefit by sticking to an ELSS. You might as well go with an open ended fund, right? High value insurance policies. Now, already there are quite a few. Please read this in detail. Where we have mentioned about the high value insurance policies, they are already being a bit penalized because the government does not favor, anything where the premium is over 5 lakhs, etc. So, yearly premium. If this, with not really getting any benefit out of these, you might as well be with more open and transparent products. Why lock yourself in for 4 years or 5 years not knowing how the performance is going to be, etc. The same holds for deferred annuity, money back policies, etc. You don't need them. I mean, if tax was a consideration, they were anyway poor returning products. If tax was a consideration, you have other options today. Post office schemes are giving you better. There is RBI floating rate bond that gives you far better. Those are better ways to earn income. If you really are looking to build a pension, you can invest in these options and generate, because these are all interest payout options. Government gilts, RBI floating rate bonds, and post office schemes, all of them give you interest income. So you can look at those options instead of looking at these kind of policies. The other thing is your fixed deposits with bank or post office with tax saving, all that you can now, I mean, you can keep them as a low risk component if you want to, but not for tax saving purpose, right? So these are things that they are imminently skippable options. So you can just leave them out if you're under the new tax regime. Under the old tax regime, obviously, your HRA or your home loan and some amount of ATC like your health insurance, term insurance will give you enough cover there. So you can continue those. You should continue those. Only then, you will be able to get, use the calculator, please. Use the Excel sheet that I just showed you to decide, and then, kind of decide what options to retain and what to skip. So broadly, these are the kind of, investment options that you need to either continue or you can afford to skip henceforth. And what will you do with those? You can consider investing them in far better options today, without thinking about tax, without being inefficient, making inefficient investment decisions because of tax. You can look at investing in mutual funds, SIPs. You can look at investing in index funds and ETFs. You can, if you're a savvy investor, you can deploy some in stocks, or you can look at simply government bonds, right? Government bonds may not give you ATC deduction, but right now the yields are attractive. You might want to lock in, etc. So there are plenty of options. Those options are, of course, covered as part of our recommendations on the platform. You can always check them. Do register for free, and also check out the other options that we have that remain tax efficient, as in the post tax returns are decent enough for you to want to add them as part of your wealth building portfolio. Hope you found this useful. Thank you.
Investment in securities market are subject to market risks. Read all the related documents carefully before investing.